We're joined by Radhika Rao, Senior Economist and Executive Director at DBS Bank. Radhika, great to have you on, and thank you so much for speaking with us this morning on India Market Open. How do you see this blow hot, blow cold kind of data, or would it be better to look at it in this way that GDP data actually comes with a lag?
Hi, Tamanna. Certainly, thank you so much for having me. I think after the conversation around the GDP numbers, you called it blow cold, blow hot. I would say it's half glass full, half empty, in the sense that there are positive takeaways from the GDP numbers, especially when you see the undercurrents. Yes, it comes with a lag, so we're still talking about the July-September quarter. And in that, you can see that, if you take the statistical effect out and if you take the deflator impact out, undercurrent, there are some positive news, especially for consumption. We can see a bit of a lift. And the GST impact had not begun to show fully in those numbers. And then, if you shift focus to what's happening to the high frequency numbers, that's where there's a bit of a disconnect. So I would say that, yes, the GDP numbers perhaps not as strongly, like about 8% plus might not be giving us the complete picture. But if you take away some of those statistical effect, I would say there are some cyclical tailwinds that certainly helped that quarter of GDP. And I think just taking this forward for the October, December as well, we're going to have similar factors. In fact, we do think that, inflation numbers or deflators could slip into negative, which means, again, your growth numbers are going to look very, very strongly higher. So we're talking about three quarters, literally back to back, where we're going to see this amount of distortion.
Okay. Radhika, how much would you read into, and good morning to you, Alex, here, into this IIP figure? Because, of course, high frequency indicators, on the one hand, you look at IIP, on the other hand, you look at something like the automotive sector, where you're seeing the latest production figures, and I understand that this is a product pushed from the factory to the dealership, but it's still significant, right? 30% for a two-wheeler manufacturer, 37% for small cars. How do you read that?
Hi, Alex. Those are numbers. So if we take timeline from August to October, I think they're going to see a lot of distortions. We had initially, especially when you talk about the indirect tax rationalization, mid-August was the announcement. The details came in thereafter, and then September 22nd, late September is when you actually saw those rate cuts happen. I think those would have impacted production, I would say trend as well. Not only so, you would see a dip earlier where people are deferring consumption because it's going to come. They would rather take the lower tax rate when it kicks in. And on the manufacturer's side, they would have built up more inventory, which thereafter they hope will go, from the factory to the dealer and to the final consumer. So these numbers, and in midst of all of this, we've got festivities, which are seasonally a very strong period. So going back to your question on the IIP, I would bring in all these factors in. Certainly the number was a bit of a disappointment, I think, as compared to at least consensus. But in that month, you've dealt with a festive period, which is a bit different from the last few years. We have also dealt with unseasonal monsoon. We have also dealt with GST-related changes in terms of demand and supply patterns. So I would read that number in that context. But I think there is no shying away from the fact that when we look at the breakdown industry-wide, barring few industries, especially like electronics or partly auto vehicles, there are labor-intensive sectors which seems to have shown weaker production trends. So I think the impact of the tariff, which kicked in August and got increased further in September, is beginning to show in the numbers, especially on the production trends. So I would say we'll wait for November, and then October-November average perhaps will give us a better picture. But we'll have to keep all of these background factors in mind because IIP is usually a very volatile number, and these numbers are not helping in terms of which way these numbers are going.
Interesting, Radhika, but I wonder if these numbers strengthen the market's belief that a large rate cut and a dovish commentary is en route or not quite. Also, Radhika, just tying it in, does the currency conversation become very important, this policy, because the rate cut is almost a given in the minds of the market participants at least?
Yes, certainly. I think all the factors that we spoke about, hi Neeraj, I think what becomes important is to see the central bank's decision as a confluence of all of this. So if you compare October to December, so what has changed and what has not? I think growth numbers have become certainly much stronger. They were expected to be strong. They've come in even firmer than that. You've got inflation that has undershot the central bank's targets by a significant margin. And then we've still got delays in this US-India trade deal announcement. So this is not an easy decision. I think prior to the GDP numbers, we had expected 25 basis point cut. I would say after the GDP numbers, probably the probability of that move has come down a bit. But I think there has to be a very, I would say, dovish forward-looking bias that the central bank will have to adopt. If they cut, I think they will have to also signal that more is in the pipeline to prevent a hardening in yields or rates in general. If they don't cut, then I think that onus becomes even higher in terms of maintaining the communication about the moves going forward. And I think they have ample, numbers to cite, like you rightly mentioned, high frequency numbers. What happens when the GST impact fades? And then of course you could shift gears and talk about the rate sensitive flows as well. Especially, we have got the current account GDP, current account numbers that have just come out. The BOP has dipped into deficit, which basically, and mainly because rate sensitive flows have kind of slowed, especially the portfolio flows. So a whole lot of, I think, set of numbers or justification one can cite for the central bank. I would say if inflation targeting is their main, to go to in terms of reference rate, I think it does open up the space for them to cut. But equally important will be communication. They can't cut and not sound like there is more or that they stand by to do more, because otherwise we're going to have a redo of how the June meeting went, when in fact after 50 basis point cut, markets went the other way.
Yeah. So it's not enough to just, the actions are not going to be enough. The direction is also key. Just, wanted to get your view, Radhika, on some of the explanations for the kind of numbers that we're seeing. GST, of course, was GST cut, so you expected some kind of turbulence there. On IIP, one of the theories is that you had Diwali on October 20th and you always have some downtime because of Diwali, so that explains it. Are you buying any of this? Is it possible that these are all just monthly trends because of a variety of factors that could stabilize? Because there is a lot of mixed cues in the data.
Yeah, absolutely, Naman. I think, as we discussed, there are at least, to my mind, about 4 or 5 factors that we need to keep while we're interpreting most of this. And I think when you come towards November, December, we would have begin to see the initial impact of the GST also kind of, pass or you will see passage of those factors as well. The monsoon would have also been behind us. We start talking about the Rabi crop. So the discussion will tilt a bit. But yes, I would think most of these data will require some amount of context. But that said, again, it goes back to the point that, is the economy growing at 8% and is that the potential growth rate? I would say that the potential growth rate is a bit lower. It's probably about 6.87%, that kind of range, and not as high as the numbers suggest, because again, there are some statistical effects playing up. So after this quarter and the next comes about, I think we will get a bit of a clearer picture. So these, I would say again, from August all the way till November, we should keep a variety of factors in mind. But come March, we should have a lot more clarity on what the underlying trend is. And most in the market are also going with the assumption that there's going to be a US-India trade deal. Initially, it was supposed to be after state elections. Now we are towards the end of the year, perhaps by December. But we do expect a resolution. So that, again, kind of a relief for production trends, manufacturing, as well as especially on the labor-intensive part of the sectors. So I think all of these numbers come out, you will see the market back this up by certain reasons. But I think come December, come Jan, March, the underlying trends will become more important. And I think there we will see a bit of softness creeping in. So if you take out again the deflator, that barring perhaps bit consumption holding up, service exports perhaps also holding up. But otherwise, in terms of the undercurrents, it might not be as robust as we had seen, especially in the last quarter and this quarter.
Okay, Radhika, thank you so much for speaking with us. Radhika Rao of DBS Bank there. We will have to wait and see if some of the factors which have led to high-frequency data not being that exciting even out over November and December.